Hello, everyone. How are you today? Thank you for choosing to attend my presentation about my mentorship. I truly believe that I had a great experience, and I'm eager to share it with you today. For me, it wasn't about getting information from my mentor and regurgitating it into another pointless presentation to read off of. It was about finding my passion for learning and finding a topic to apply to real life situations. Working with multiple mentors at Bridgeway Capital Management proved to be the most insightful thing that has happened to me throughout my high school career. As a future business major, I learned what capital management was and the many different teams that make up the company. The topic I chose for today was about analyzing the organizational makeup of Bridgeway Capital Management and identifying the underlying principles between growth and value stocks. First, I want to talk about the uniqueness that makes Bridgeway what it is. So here's what I'll be covering throughout my presentation today, starting with the Bridgeway overview and ending off with a reflection. My reflection is basically about what I've learned at the company and what I need to do moving forward. So Bridgeway, essentially put, is an asset management company. An asset management company are firms that invest pooled funds from clients, putting the capital to work through different investments. Basically, capital is the money you get, and investments could be, but not limited to, stocks, bonds, or real estate. Um, that's what an asset management company is. An asset is something that appreciates in value over time, and that's what Bridgeway does. They just put money into this managed assets. Usually, Bridgeway does not deal with individual investors. Many of these companies, such as Bridgeway, often offer different kinds of products for different types of investors based on the investor's preference itself. The products are called mutual funds and consist of investments in different companies based on the investor's preference or different products based on the company. Bridgeway is also purely data-driven with years of hard research about the market itself. So basically, mutual funds are a collection of different type of stocks you can put your money into. That's pretty much what mutual funds are. Now that we have broken the tip of the iceberg with Bridgeway Capital Management, let's talk about some of their humanitarian efforts that makes them unique from different other companies. Founded in 2000, the Bridgeway Foundation aims to combat genocide around the world. By doing this, what they do is they tend to give back to the community by donating 50% of the profit against the charity. The founding father of this idea was John Montgomery, who laid the foundation of the idea. And this is basically another helpful way of giving back to the community, which has basically served Bridgeway for so long, kind of like a thank you. Another big thing at Bridgeway is servant leadership. Behind every successful company are even more successful employees. At Bridgeway, the approach to success is through servant leadership. Servant leadership is essentially the goal of leading is to look after the employee and the leader itself and help them basically evolve in a way that benefits the leader, also the employees, which in turn elevates the company, basically evolves the company in a way as well. Another fun thing I learned about at Bridgeway was about the term partner. At Bridgeway, they don't refer to their employees as employees. Instead, they refer to the people as partners. Like, even if my leader was my leader for my team, we don't refer to him as like a leader, we refer to him as a partner. And basically, it's just committing to the growth of people. That's what servant leadership basically is. You grow yourself along with the people you work with. It leads to more collaborative decision making, which I think is a really cool thing that I learned about. Also, Harvard researchers have found that people who enjoy their work and do it like they like what they're doing are 33% more likely to stay in their job. And that's what the goal of servant leadership is. It basically gives into the Bridgeway culture itself and creates like a positive outlook inside the Bridgeway culture as well. Now that we've moved on from the Bridgeway culture, let's talk about the fundamentals of investing. So first, we have the types of investments. Bonds, stocks, and real estate are the common types of investments. You see this all around the media, like social media and stuff. You see like people selling, courses for real estate itself. Bonds might be a little tricky, but stocks also are some of the more common things that people know about. At Bridgeway, they focus on both value and growth stocks, I'll be specifying them later on in my presentation. But what Bridgeway offers is something called a mutual fund. As I said before, mutual funds is basically a bunch of companies together in one fund, and you just put your money in it, and it just dispersed into different companies. That's what a mutual fund is. It's like a collection of different companies you can invest in. What comes with investing comes diversification, which is allocating your assets allocating your money in different assets. The purpose of this is risk management. You don't want to have all your money put into one stock. Instead, you want to have put into multiple stocks in order to lower your risk of losing your money. Basically, the second point says that diversification provides investment across several assets, therefore decreasing reliance on any single investment. It decreases the risk. So if you put your money in different assets, you can sleep well at night instead of worrying about what happens if you put your money in one single investment. So it also depends on like the investor's preference as well, you know. Different investors have different risk profiles or concerns. Some investors might have high risk, meaning they might have, you know, a lot of capital itself to start out with, and they might take like big bets, basically. Versus someone who's more conservative might focus on something that's value. I would say it also depends on, you know, age ranges as well. Young people tend to invest money, you know, into more like risky stocks as opposed to older people. Older people, they might not want to risk the money they already have saved up into stocks that show high volatility, like meaning like just like a bunch of change, but the stock basically just like changes every like, you know, it just changes a lot. That's what volatility basically means. So yeah, that's the fundamentals of investing. So what is a growth stock? A growth stock is basically something that's like an emerging company, you know, starts out small and grows. Usually it falls under the small cap bracket, which is around um, like 2 million to 10 million profits they see. However, with growth stocks, investors might pay more to expect to expect a rise of the stock in the future. That means the price you're paying for the stock itself is a little bit higher than what you pay for a value stock because you expect a rise of it in the future. That's why that premium is so high. And because that premium is so high, growth stocks don't pay through dividends. Dividend is basically the money you get per share after the company has announced their earnings. And growth stocks don't do this because they want to focus on expanding their revenues and earnings quickly. So all the money you put in, they regurgitate that and try to maximize profit in order to grow the money you've already have put in. Growth stocks can be riskier than value investing because if growth never happens, the price of the stock doesn't go up, and you could potentially lose your money. Let's look at Amazon. You see the growth happening a lot faster than you would see as a value stock. In the last decade, you can see how fast the stock has risen. Even then, the price you paid back in 2011 was still a high premium. The price a premium is basically the price you pay up front for the stock, as opposed to a value stock. But let's look at the Amazon dividend payout. As I said before in my second point, growth companies tend to take all the cash flow they get or all the earnings, and they tend to like maximize on it and grow the company even more. Because of that, they can't pay their investors through dividends. As I said before, dividends are basically a price you get per share after the companies announce their earnings. As you can see here, even since 2014, Amazon has not paid any of their investors back their dividends, but the guarantee of the stock going up is a more, you know, incentive for investors to buy Amazon stock. Now, what's a value stock? A value stock are typically more mature companies. This would include your pharmacy, your bank companies like JP Morgan. Those are typically what are considered value stocks. It means like where the price of the stock actually doesn't match the actual worth, but because people believe in it, that's why the stock are kind of considered value stocks. It's not necessarily something that's based on financials, it's more based on the value of the company. Value stocks don't particularly emphasize on growth since they're already mature. So with value stocks, you see a certain growth pattern, but you don't see an insane growth pattern such as growth stocks. Another incentive for investors to buy value stocks is they often pay dividends. Dividends, as I said before, is price you get per share after the company has announced their earnings, and they often pay their investors back like that. For example, let's look at Johnson & Johnson. Since 2011, if you compare to the Amazon graph, it's had a steady growth, but not an exponential growth as we saw at Amazon. However, if you look at a dividend payout, from 2014, the dividend payout has been currently increasing and increasing. And this might be an incentive for someone to buy the stock who's looking to make passive income. Because the dividend is so high, the price per share, you could get money back potentially. That's pretty much what it is. Dividends are an incentive for investors to buy it. And the more dividends you have, the more passive income you get. That's pretty much what it is. That's how value stocks and growth stocks differ. One focuses on growth, the other focuses on still growth, but they also have dividends. Now, growth versus value stocks. As we said before, growth stocks typically have a higher premium than value stocks at the expectation of the company to keep on growing. That's what growth stocks basically are. Volatility can be higher in growth stocks. It can turn any time because growth stocks are so not as mature. They're pretty volatile. So the money you put in, you could potentially lose it or you could potentially gain from it. Value stocks generally have a high dividend or a dividend and could hold less risk to invest in. It's all about the investor's preference again. Now let's look at the growth versus value chart. This is basically a yearly returns of the S&P 500 over each decade from the 1930s. What the S&P 500 is just 500 of the largest publicly traded companies in the United States. If you look at value, they seem to be on par with each other. But what we notice here is that in the short term, growth stocks provide a higher return than value stocks. Over the long term, value stocks provide a higher return. So now what can we conclude from this? Do you choose growth or do you choose value? Well, there's no real answer to this. You want to choose some of both. As we said before, risk managing. It's all about allocating your money into assets in different areas. You want to have some stocks in growth and some stocks in value. That's basically what risk management is. So it's not one or the other. It's a balance of both. Or it could be a balance of one over the other. I mean, it could be a dominance of one or the other. It's all based on the investor's preference again. So what have I learned about Bridgeway? What I've learned about Bridgeway is that every company has a certain kind of culture. You know, Bridgeway has certain ideals and principles they follow that another company might not. Working with Bridgeway gave me insight to the financial world and the components that make it up. Before coming into Bridgeway, I didn't know that so many teams work to make a company as great as Bridgeway the way it is. I meant to meet with HR, the compliance team. Basically, the compliance team makes sure the whatever's going on at Bridgeway complies with the SEC rules. The SEC rules is basically the Securities and Exchange Committee. They oversee what's happening in the stock world, making sure nothing illegal is going on. I also realized I also got to meet with the investment team and the different kind of products they offer. Historically, as we saw before, value stocks have outperformed growth stocks on return in the long term as well. I've learned how to network better and face real life deadlines. So before Bridgeway, I didn't understand how important deadlines were. While working with Bridgeway, I realized that you have to meet a certain deadline in order to be seen as a valuable worker. If you don't meet that deadline, then you're just another person that doesn't do their work. Also, I learned how to reach out to people such as my mentor and other people inside the company to help me on my project itself so I can gain information from it. And the last but not least, Bridgeway purely focuses on analytical data to support value and stocks. So Bridgeway usually leans towards value stocks, but that does not mean they don't deal with growth stocks. However, the data that they have derived from the years shows that they support value stocks a little more than growth stocks, and that Bridgeway is purely analytical itself. Thank you for attending my presentation.